you. Tonight, the November to remember whiplash. The Dow sets a lifetime record yesterday and is down 800 points today. And that's not the only whiplash we've gotten this month. And the government shutdown is finally over. How much did it cost the country? How much did it cost us as American citizens? And what does this mean for the rest of the year? And third quarter earnings on fire. That's the really great news of the night. I'll get to that in just a little bit. It is Thursday, November 13th. I am Charles Brown, your portfolio manager from Chicago. This is CB3 Live. Well, certainly it's great news that the government has reopened and 900,000 people are back employed. And my son, who was on a flight today, managed to get there safely without any delays, just in the nick of time. So, a lot going on in America. I'll cover as much as I can tonight. Your questions are always welcome. Here we go. A November whiplash. What does that mean? It means that the markets are behaving in November the way they usually behave in October. Stocks power higher for 3 weeks, defying the seasonal odds. And then the S&P back at highs, the Dow at highs, but tech is no longer leading the charge. What does that mean? We'll get into all of this. So how did the market hold up during the shutdown? Amazingly well. And now that it's over, why did the market semi-crash today? Well, because all of the euphoria was already priced in. And what will we see with the earnings reports so far, guys? It's really great. We're not completely done, but it's about 90%. Third quarter earnings, the best in several quarters. So what does this mean going forward? Let's look at the market review. So the Dow, as I said, surged to a record high yesterday, just yesterday, over 48,000. I think it was 48,250. Investors anticipating the end to the longest government shutdown in U.S. history, 43 days. Meanwhile, technology stocks tumbled, and the takeaway on this, folks, is that the reality is that rotation is what's going on here. Rotation is what's going on, and we are rotating from one sector to another. You're going to see all this in the charts coming up, but that always causes bumps in the road because literally trillions of dollars of positions are being moved. And this is affecting the technology sector, which is the biggest sector by far in the S&P 500. The blue chip Dow did great yesterday, not so good today. 16 record closes as of yesterday. Dow added just a little bit. And again, this is from yesterday's data, okay? I didn't have a chance to update all the slides with the market's sell-off today. But the sector rotation that we're talking about looks like this. So here's the fourth quarter performance going all the way back to 2010. As you would imagine, the green bars are good. The yellow bars are pretty good. And the red bars kind of what's going on here. So for the first time in 15 years, this fourth quarter is kind of iffy. So it's succeeded as being the best performing quarter on the calendar, 13 of the last 14 years. But this year it has definitely gotten off to a rocky start. Now, it's almost always rocky in October, and it was this year, but not anything close to the way it's been in November. And of course, this is not a normal seasonal pattern simply because the government had its longest shutdown in history and opened just this morning, or I guess shortly after midnight when President Trump signed the bill, I think 20 minutes after they voted on it. And so all of this was already priced into the market, and people hit the sell button like crazy today. Market's already up overseas, so I'm not really concerned about this at all. So if we go forward, though, this is what we want to see. We want to see lots of green, obviously, in the fourth quarter, because if an average market performance is about 9% a year, somewhere between, you can see the blue line, that's the mean, just under 8% of that comes in the fourth quarter. So that means, as you would expect, the first three quarters are doing 1%, 2, maybe 3%. And of course, there are anomalies to that. But the fourth quarter, because it's heading into holiday season, portfolio managers squaring their books, doing window dressing, they call it. So there's a lot of buying going on, 401k, extra makeup contributions perhaps. And when that is propagated over 330,000 people, that's why we generally see this be a stronger quarter, but that's going to be an anomaly, I believe, in November. I do believe December is going to get back on track. So just looking at October this year and November historically, so this is not November this year, this is November on the left-hand side, historical November, average 5.2%. Again, that's really an important number to know. That's over half of what the annual return is, 9% since 1950. There are years that are blockbuster beyond that, like last year. I mean, CG was up 29%, DS was up 34%. Even GI, which is normally a pretty conservative program, was up 15%. All right, it's a little tougher going this year, but anyway, I just want you to understand that when you see this happening in the market, it is an aberration. It is an outlier of November performance. So that's why you see the red bar here. This is the worst start since 2012. So if we go back to 2012 on the chart there, you can see it was up 0.6%. Remember me saying that the mean is somewhere between 5.25% and 8%. That blue line shows you there. So what does this mean? That's really an important question. Is this the government shutdown totally? Is this people looking at the valuation of the Magnificent Seven or Eight, if you include Berkshire, and saying, no, this is just overpriced? Is it both of those? Is it fear of macro events? Is it fear because of political events? Who knows what it is? There's no way to ever look into the mind of the investor during the market while it's happening. So we have to analyze it afterwards. That's why we can't predict, and our ability to predict is not nearly as important as our ability to react, as you guys have heard me say for some of you 2 decades now. So will November bounce back? That's what the yellow type says. Or will it continue with this October volatility? That, of course, depends on how many government reports are going to be issued. We're hearing now that they're not going to go back and issue the September report, which of course would have been presented the first Friday in October, and maybe not even go back and issue the October report, which means the December report is going to be 3 months worth of data. And talk about a volatile day on Friday, December 1, 2, 3, 4, 5, right? But that's a few weeks later and after the holidays, not going to, or at least after Thanksgiving, not going to worry about that right now, but that's what we're facing as PMs, portfolio managers, right? So just a reminder that the largest companies in America are represented right here. These companies added together are bigger than all but 3 countries in the world. And every single one of these is in one or more of our portfolios. So when these guys hiccup, the market catches pneumonia. And you can see on the chart, Magnificent Seven, 15%. Now this is obviously a few days old now on this data, but look at the difference between the Mag 7 and the S&P 500 with the black line. All right, the NASDAQ, look how much lower the NASDAQ is, even 5 whole percentage points. So that is how important it is for the Magnificent Seven to perform, okay? Now this is a new chart. You guys have not seen this before, but you don't have to see the numbers, all right? So I know those of you on a phone, don't worry about it. The colors are what you want to pay attention to. Green is good. You see in healthcare, a lot of money rotating into healthcare. This is a weekly basis. Look down at the bottom. There's 4 columns here. Week 1 is October 15 to 19, October, and then the first week of November. We don't know about the second week of November. It's not over yet. But the money's going into industrials, financials, and healthcare. It is going out of communication services, which is the second biggest sector, and technology, which is by far the biggest sector, red. A little bit of yellow at the end there, but just red. And it is this rotation that we're seeing in the markets. People saying, you know what, I've made enough money there. I'm going to go back into some industrials. I'm going to go back into maybe some consumer staples, maybe some communication services, maybe some real estate, maybe even some utilities. I think that that's probably not a wise decision. We are not doing that yet. We are prepared to do that if we need to, but this pullback is absolutely garden variety as of right now, all right? So this is what I've been describing to you, the great rotation. And this means that money is not leaving the market. And I can't emphasize enough how important this is. If money were leaving the market and going into money market funds, going overseas for some reason to be invested in China, I mean, why would we do that, right? I mean, you can invest in Chinese stocks right here with ADRs. So the point is, it's not leaving the stock market, it's rotating. There are 11 sectors, all right? Just as a reminder, there are the 11 sectors. All right, it's rotating to defensive sectors. What's a defensive sector? That does not mean that they make bombs and planes. A defensive sector is a sector that can defend itself better than an aggressive sector. So a defensive sector would be consumer staples. That's your Procter & Gamble. Who do you think has more risk to inflation, to supply and demand, to global shocks? NVIDIA or Procter & Gamble? You're correct. NVIDIA, all right? How about Palantir versus Eli Lilly? You get my point, okay? So the defensive sectors are what's picking up dollars, and it's coming from the tech sectors. We are pretty heavily invested in tech, and it has worked very well for us. We beat the S&P 500. I don't know that we're going to do it this year. We're going to be close. All right. And then we start over again in January. And that's the way the race is every year. All right. So the valuations for the S&P 500 and especially the big stocks. So this means the valuation, in other words, PE ratio. So let's not get on the, whenever I talk terms, I want to be on the camera and look at you here. The price to earnings ratio is how many multiples you're paying for a stock. Or you might say, well, if the stock's going to earn $20, I don't want to pay more than $20 for the stock. Well, you could say that, but you never get filled. All right, that stock's probably trading for 80, 90, who knows? All right, so 35 times multiples. You see this with Tesla. You see this with NVIDIA. You see this with Palantir. You see this with Fizzler, First Solar. All right, so it peaked. There it is in 2000. And look where it's inching up to now. It's not anywhere quite there yet, but look today, 27.9 multiple PE ratio, and the dot-com peak, 35. So what's the memo here to self? The memo is, this is getting rich. Does that mean it has to stop when it gets to where it was in 2000? It does not. Again, my ability, and not just mine, but every portfolio manager's ability to react is far more important than our ability to predict. We do not know where this is going to rise. If the PE's average go to 38 or 40, and the market is still showing earnings. Remember, we're going to get to earnings in just a minute here, but earnings are what drive the market, earnings and interest rates. All this other stuff is just elephant talk. You know how elephants talk? Just yelling and screaming stuff, all right? That's what it is. That's what the corporate media is. That's what all these histrionic people predicting that, the Chicken Little's going to, doom the world. It's not going to happen, folks. Are we going to have days like this? Absolutely. We've been having them for 20 some years that you guys have been with me, and we've survived every one of them. The fear index. Let me just do a little VIX lesson here. Volatility index, VIX. Talked about this for years. This is something provided by the Chicago Board Options Exchange. It is an option. It is an index on options. And without getting too much in the weeds, it is a measure of fear. When people fear something, they are buying puts. All right. If you remember from the last two shows, we buy puts for our portfolios. We don't buy them when we're freaking out. We buy them when the times are calm. 4 times a year, all the Schwab clients, and that's 94.5% of you right now, trying to get the last few over before Thanksgiving. But we all have that option strategy. You can go to our website and see an extensive segment on the whole Schwab move and why we did this for many reasons. But one of them, of course, is the options hedging ability. But look here at the October, which is pretty healthy in green, all right, in all the different sectors. And this is this year. And now look at the volatility in November, definitely weakening. That is not historically the case, as I've been saying all night. November is the #1 producing month of returns since 1950. About 6 charts ago, you saw 12 out of 13 of the last years. November's been up and strong, more so than any other month. April's second. April is second, not April 2nd. All right. So this year is an aberration. Now, could this mean that December is just really going to pile on to the upside? That is possible. Could it break the other way? Well, here we are, folks. Here we are. We are at a fork in the road. You see the we are here? Look on the left-hand side. Key catalysts. The shutdown resolution, the Fed December decision. It really matters if we get that additional rate cut, because if we get it, not only do we get the quarter point benefit, but we get the implied concurrence that the Fed is saying, yeah, our data says we need to do this. We've got other risks in the economy. We better cut this, even with inflation a little bit higher than we want it to be. I have a whole long segment on inflation tonight. All right, so the tech sector really has to stabilize and support levels holding technically in the market. So the optimistic path on the right-hand side in green, the shutdown resolves to the upside. Now, today was not a good start, but again, this has nothing to do per se with the shutdown. How many people are going to be rehired? Is the Trump administration going to try to use this opportunity to institute permanent layoffs? We don't know any of this. We've never had a government shutdown last this long. Incidentally, the last one we had, the second longest, was also during Trump's Trump 1, they call it, right? Will there be a Fed cut in December? Will the earnings beat? Well, we already know that. I'm going to get to that in a second, but I can tell you they're beating. And will we have a year-end rally? That's what I just said moments ago. Because November is down, is December going to say, well, hey, I got to jump in here and help out? Now, I don't know that months really talk to each other like that, but could that happen? We still have the window dressing factor. We still have the 401k catch-up factor. There are lots of just mechanical things where people are funding retirement accounts heading into the end of the year. They're doing makeup contributions. And if they're not going to do them in November, they could well do them in December. We'll see what happens on that. But here's the pessimistic path. If the shutdown, and it's not the shutdown itself because that's solved, but if the shutdown effect drags on, if the Fed stays hawkish, as you well know, hawkish means more conservative. And dovish means, yeah, we're going to go ahead and cut a quarter. And of course, there are some people that want to cut 50 basis points. That's not going to happen. If there's earnings disappointment, so far that hasn't happened. And if there are recession fears, you do not have to be concerned about that. My last module, next to last module, is all on recessions. Because I continue to get questions about, is inflation going to wipe us out? Is it going to wipe out this bull market? What about a recession? We'll talk about it. Hang in there with me. Here's our favorite chart to end this segment with. The mean number, middle number, is 73% over the last 10 years. We are at 83% with 446 companies reporting. That means 83% of them beat the forecast that they had last quarter. All right, so they issued their earnings report, and then they said, here's what we think for the next quarter. All right, so you got consumer staples, which is a defensive sector, but look at that, 88%. Financials, 91%. Healthcare, that's why you saw all that green on healthcare on the heat map that I showed you. Technology, that's a big one, 90%. So this bodes very, very well going forward, irrespective of what happened today in the market. You guys with me on that? All right, let me check the chat here and see if there's anything going on. I'm gonna get a sip of water and then we'll look at performance, and I'm gonna show you how this works. If you have a browser up and you wanna know how to do what I'm doing and you've got two screens or whatever, go to CB3 Financial. That's where I'm gonna head right now. I'm gonna show you the new reporting system, okay? Well, hey, Kate and Don from Georgia. Glad to have you guys with us too. All right. So if you go to the home page, you will click the tab that says performance. This is how you can see at any time how your accounts are performing. Click the performance button. When you click that, the next page that comes up is this one, and the little performance word still there. And our three programs are there, DS, CG, and GI. I will show you DS tonight because I don't want to take the time to go through all of them, but you just go there and click on any button that you want. All right, so the way we have this done, and no, you can't read all of this on your screen, but this is what it looks like. And you can hit print, you can print it out at home, however you want to do it. But just to give you a summary of what's here, the overview of the program, the performance is the dark line, the S&P is the green line, a 60-40 stock program is the red line. It's month to date, year to date, 1 year, 5 years, total returns, annualized returns. I mean, just pretty much any configuration you might want. The maximum drawdown, things called the Sharpe ratio and Sortino, which I don't go into here, but if you want, I'll explain it to you sometime. You can see the actual holdings that are in here as of the end of the month. And then every single year, this program has a 7-year plus track record, and there it is on page 2. So everything we do can be done on a front and back page, okay? So then I have folks say, this is great, but what if I come in on the 27th of November and, you know, all I see up here is October, how am I doing so far? So then you have to go on your Schwab account, see the Schwab logo up there, click the summary button, and then click the portfolio performance button, and you'll see from to. And you can pick any date range you want. You can pick the last 3 months, you can pick just the last week. You know, I see the little buttons there that say 3M for 3 months, 1 year, 2024. But then you can just type in any date that you want. And the blue line is the performance of the program, that's DS, and the black line is the S&P 500. It's not super fancy, but you can see how things are going. All right. So good to know that. I hope you guys will use that feature. I will not be covering this much on my programs because there's so much else to cover, because now you can check performance anytime you want. So US policy, as we know, policy is something that we have to live with. We might hate politics, but it turns into policy. And so we have to pay attention to it. So this government shutdown, which ended just last night, 43 days of acrimony, was different than all the others. Why? Because it lasted longer, it cost more, and probably accomplished less than any of the shutdowns before it in history. The shutdown will create a permanent loss of $70 billion to $140 billion in gross domestic product, according to government estimates. I think those estimates are high. I do. But even if it's 50 to 75 billion, which granted is just like the interest payments on the debt for a couple days, but still, it's just too bad to throw that away when this should have been able to be solved. It really should have been. So this event was the most expensive shutdown ever. It was a step beyond anything we've seen in the past. And as long as we're this deeply divided, I predict the shutdowns will grow longer and costlier, and there could well be another one during President Trump's term and into the next term of whoever is president after him. When 90% of America is pretty much dug in their heels, there's not a whole lot of room to move, correct? Thus, that's why we had this event. And so because of that, everything gets politicized. So this is a polymarket poll on when the government shutdown is going to occur. I just wanted you to see this. I had this plan to go in here. I didn't know it was going to end today, but it doesn't matter. Most people in this survey thought that this was going to be November 16th or later. Well, it was actually a little bit earlier than that. So the people that bet 19%, no 12 to no 15, won. But still, it only got done because 8 Democrats decided to join the Republicans and get this thing done. So here it is, the longest in history, second longest, December, almost exactly 7 years ago. So yeah, and it happened during Trump's term. So this is what it looks like. And the chart that you see in blue here is how the market performed. So the minute the government shut down, technically on the 29th of September, and then went into effect on Wednesday, October 1st. But the market started heading down for sure, because there's a data blackout. That's what you see with that yellow arrow. When there's a data blackout, folks, it means there's no CPI, there's no non-farms payroll. All of the Michigan consumer sentiment, all of these government policies, statements, datum, don't get issued because the people that are getting paid to do it have been furloughed, and they're not going to come in and work for free. Which leads to another question. Why do we ask our air traffic controllers to work for free? But I digress. So what you need to know is that's why the air traffic controller crisis peaked down here at the bottom. And once it looked like that was going to, see some light at the end of the tunnel, the stock market turned back up. So the duration, 46 days, if you include back to September 29, 43 if you started with October 1st. Market impact, at worst, it was a 6% drawdown. Now, I would say a 6% drawdown is not even a correction. It's just a garden variety. Anywhere between 5 and 6 is a garden variety. It just doesn't feel like it at the time. It was pretty ugly. I mean, we had positions in CJ today that were down 4, 6, 9%. Robinhood was down almost 10% because, again, people just pulling out their profits and putting them into other areas. But then what that means is people come in and say, gee, this is stocks now on sale, 10% cheaper than it was yesterday, and they rush in to buy. So that's normally the way it works. So these are the returns. Again, too much data to try to focus on all this. Just look at the blue lines. The blue lines is what is the 3-month return after a shutdown. In almost all cases, going back to 1932, all right? I'm sorry, 1982. It's positive. And certainly the last one, 2019, after 3 months, was very positive. I expect this move today and the effect on the market to be an aberration. There are just too many good things happening, like the earnings I just showed you, like the $3 trillion of foreign investment coming in here. Why? So they don't have to pay tariffs. if they build their plants and hire American workers or bring in their foreign workers here and they become domiciled and pay taxes here, then it's a great thing. It means they're investing in the infrastructure of America and making us a more autonomous society and economic system that's not dependent on countries for cocoa in Africa or rare earth in China. So I think these blue lines are going to continue. So you'll quickly see, I put this in blue and red, so I'm slamming both sides of the aisle here. One of the major criticisms of Democrats before last year's election was that they kept talking about how low unemployment was, how wages were rising, how inflation was falling, and a bevy of other numbers showing an economy firing on all thrusters. Well, some of that was true, but the reality for many lower income Americans was that they were still struggling to make ends meet because of inflation. Fast forward just 1 year, and what do the Republicans say? Well, unemployment is rising, wages are stagnating, inflation has hit 3+%. But at the same time, the Wall Street obsession with a handful of technology stocks, and that's important, a handful of technology stocks has catapulted the market to new highs, making the disconnect with the rest of the country more pronounced. So what does this look like on a chart? All right, here's what the Democrats said and what Americans felt. Unemployment was going down, wages were going up, inflation was going down 2.1%, but the reality is grocery bills up 30%, rent up 40%, credit card debt literally at lifetime highs. So is the economy great? Well, for whom? All right. And on the Republican side, they're saying, hey, Wall Street's looking great. S&P up 21%, tech stocks up 40%, NASDAQ 15% just year to date. Top 1% wealth, 2.5 trillion. Well, I don't know about you, but I don't really care about the top earners of this country and how much increased wealth they have. But I guess that's a stat that needs to be reality placed here. So reality-wise, though, this is what's happening. Unemployment is up from 3.7 to 4.3. Jobs created only 22,000 last month, 75,000 expected. Wage growth is stagnant and jobs are disappearing. Some of this, of course, is because of the attrition that may or may not be permanent because of the government shutdown. I mentioned that earlier in the program. We will see how that works out in the future. So here's the shutdown and spending chess. Financial year-end brinksmanship is back. The White House is framing discipline, not default. Treasury cash levels remain healthy, but the Fed agencies have begun their pre-shutdown contingency plans. They have that in place these last 43 days, and it is still in place. Still in place. Markets have shrugged this off for the most part until missed paychecks hit consumer sentiment. We're going to look at the charts on consumer sentiment in just a minute. Incredibly, it's staying strong, and that is because Americans just aren't going to stop spending unless it's a catastrophe in their economic system, and it's not yet. T-bills widen. That's what we saw early on. That's why the stock market went down. You saw the chart on that. And watch this last minute deal, even if it is definitely not in sight. Well, this was a slide that I used last time, and I updated all the lines but that one. Well, there was a last minute resolution. So I needed to just change the word extension to last minute resolution. I mean, we had 8 senators join, then the House signs it, and they wanted to do this just in time. So there were 2 days left for the weekend here instead of doing it on a Friday afternoon. And I'm glad they did that. So Jay Powell, poor guy, he's just going to get beat up probably from the president the rest of his career. Here's where we are. The interest rate journey started at 5.5. That was the peak, all right, long before Trump entered office here. And it started going down here in July during Biden's last year of his term. And the cutting cycle has begun. The current is 375 at 4. So years ago, we used to have the Fed funds rate is 3%, 4%, 3.5%. But now they have a range, all right? And it's tricky to explain that. But whenever you see that, the way to say that is 3.25 at 4. 3.75 at 4 is what I should have said. 3.75 at 4 is how you say what the current Fed funds rate is. And that could drop by 25 basis points, and I expect it will in December. But Powell has said this is not a foregone conclusion. Look at the chart there in yellow. And the minute he said that, look at the bets going off on October 29th at the red line dropping there. That's the 50 basis point cut. Everybody went, no, not going to do 50. We're going to be lucky to get 25. So it's really important that you listen if you become a Fed watcher or a Fed listener, because you'll hear the news people say, last time there was a comma at the end of that paragraph. This time they put a semicolon. It's almost like they had to think about it more. I mean, my grammar teacher didn't spend that much time on my term papers, but when you're talking about Fed speak and the power to regulate the Fed funds rate, short-term interest rates in America, which metastasize in a good or bad way to the rest of the world, you have to pay attention to the Fed. You just do. And that's why we do what we do. So I continue to get questions on inflation. I continue to get them. Hey, Karen, good to see you. Just saw you down here. Hope you're doing well. Hope you and Ken are doing well. So inflation, what risk do we have? So inflation is what I call the silent wealth destroyer. It's not like somebody robs a bank. It's not like you lose your job and you can see the money going out, you're spending it, nothing's coming in. But what's happening is there are external factors that seem somewhat invisible. All right, so gas prices, they are up. So you're still buying gas, you still have to drive where you need to go. It's just a little bit more, but 18% actually adds up depending on how many times you're going to the filling station a month. The value of the dollar. So we're seeing the opposing currencies, which is every currency that's not a dollar, but mainly the euro and the yen, and to some extent the British pound and the Swiss franc are the opposing currencies. And they are strengthening, whereas the dollar is weakening. And a lot of it is this geopolitical uncertainty. But here's the killer on the end, the grocery prices. And this is still, all right, so versus 2020. So 2020 is when Trump left office, and now it's up 35%. Now, it doesn't mean it's been up 35% for just this year or these last 10 months that Trump's been in office again. What it means is that it moved up during Biden, and it hasn't really made much significant difference coming down. And if the Republicans want to get reelected a year from this day, roughly, they've got to lower grocery prices. They've got to figure out a way to do that, because it's not working right now. So here's the base case for my inflation forecast. The best case, the Fed cuts to 3.5, CPI, that's the consumer price index, falls to 2.5, and we get a soft landing. Soft landing means the economy eases back, we cut interest rates, and there's no spike. It just settles down, and we still have GDP that's strong, and inflation's about 2.25 somewhere. That would be good. And wages catch up. Remember earlier, wages are down. Now the base case, which is in the middle, about a 25% chance of that, as I see it. All right, so the base case, sticky at 3.5. That's high. We don't want inflation at 3 to 3.5%. The Fed holds at 4%, not good. If there's no cut in December, that's not going to be good for the market. And a slow grind lower, and consumer stress continues. I mentioned earlier that the consumer is still spending, but they're fretting about it. We're going to see some more charts and explain that right now. But here's the worst case. Tariffs reignite inflation. That has not happened, in my opinion. There are some people that say that it's tied to that. I don't. CPI spikes to 5+, bad. Fed hikes to 6%. That's really bad. And then a recession's triggered, and I think there's a 15% chance of that. Now, you're going to see on the recession forecast, which is the next segment, that it's a little bit higher than that 15%. But I think for inflation to really cause damage, there's only about a 15 out of 100 chance to do that. So there you go. The best case, the base case, which is in the middle, it's the middle of the bell curve, so to speak. And the worst case, tariffs reigniting and just everything going crazy. If the Fed cuts too late, then inflation is going to stay elevated through 2026. That's Mr. Jay Powell's name. Too late Powell, right? Time to cuts now, all right? You don't have to cut 350 basis points. 25 in December. There is no November meeting. 25 in December, another 25 in January, maybe March. But you really got to be tactful about how you do it. So we are better off than the rest of the country. So I I lumped together Asia and Europe here, and you can see our inflation rate at 3.2, they're at 4.1, Japan's 2.8, China 1.5, India way up there at 5.9, all right? Our status is better. They have an energy crisis in Europe. The trend is mixed in Asia. So we have lower inflation than 2/3 of the developed nations in the world, but we're still losing purchasing power. Why is that? Because the dollar is shrinking. And I showed you that on the previous slide. I know this is a lot to process, but all of these macro components make up the economy. And we're trading the economy essentially because we're trading earnings. When companies have a favorable environment, which means low interest rates, good wages, not arduous regulation, they survive and thrive. And when they thrive, they make more money. And if we own those stocks, those prices increase. So we're better off than Europe, but you know what? Better off is not really good enough. So inflation is cool, but this wealth destruction continues, as I described earlier, because as it says here, the average American's lost 22% of their dollar's purchasing power since 2020. Even though we're doing better in Europe, it's not much comfort when the government is buying beef from Argentina. Are you kidding me? Now, I don't know what to say about that. I really want to keep things here in America, but I understand that beef prices are one of the biggest issues. So I solved that by just becoming a vegetarian, but I can't expect all of you to do that. But even chicken prices are higher, right? There are quite a few foods that are not, but core staples are much higher. I don't know how he's going to get them down, but it's been 10 months in office. He's got to figure this out because the people that are voting don't like that. All right, I'm going to get another sip here, check the messages, see if I missed anything. All right, look at that dollar on fire for a recession. So I know the consumer's doing fine because the red line there, year over year, total credit card spending is rising. It is really hard for the American consumer to be kept down by any of the stats that I'm showing you or anybody else is showing them. Americans want to spend. That's what we do. That's our DNA. That's our MO, modus operandi, all right? So we continue to spend regardless of what our sentiment is. So here's the mixed signals. Let's look at the two green ones. GDP, 2.1%, that's a positive. It's in green. Consumer confidence, 102. Anything over 100 is great. We'd like it to be like 110, but 102 is still strong. In the iffy category, manufacturing, under 50. 50 is the break-even point, and under that is contracting. And then housing starts are down. Now, 12% might seem like a lot, but in high inflation, like 8, 9%, I don't build anything because then you go to the bank and it's like, I want a loan for that house. That'll be 14%. Some of you, most of you go back with me and can remember those times in the 80s when that happened. So it's not there yet, but it's something we're keeping, a raised eyebrow on. But then you've got the red numbers, retail sales down. So this doesn't make sense, right? Retail sales are down, but consumer confidence is up. It just means they're spending money in other ways than retail. Retail therapy not working for them now. They're spending it on the internet, maybe on education, maybe on automobiles, probably not on houses, all right? Not a whole lot of people that are willing to give up their 2.5, 2 3/4, 2 5/8 mortgage and swap it for a 6.5. All right, like the Browns did when we came back to Chicago. But we are glad we did for those family members watching the show tonight. We're in clients too, right? And unemployment, rising at 4.3. We sure don't want that to hit a 5 handle. That would be 5.0. So all these mixed signals we're watching carefully. So my summary, you put all this together in a broiler and cook it up, and it's about a 25% chance of a recession. Why? The consumer's resilient. The Fed is pivoting, meaning they're going to continue to drop rates, in my opinion. Corporate profits, you just saw that, 7% year over year. Tech sector is booming, even though people are pulling money out of there, but that doesn't stop what the companies themselves are actually producing. The banks are healthy. Infrastructure is spending. So 1.2 trillion being deployed. Why? Just what I said earlier. These countries are coming here and negotiating, and President Trump and his people, Hassert and the rest of them, are saying, just move here, build your factories here, invest in America, and you're not going to get tariffed. And that's why you hear these astronomical deals, 500, 800 billion, 1.2 trillion, just crazy high numbers. Will they all come through? If half of them come through, it's still astonishing for America. It really is. And then global growth. China's stabilizing. Europe is at least avoiding a recession for now. Emerging markets, okay. So will there be a recession in 2026? You can mark my words on this show right here. 25% now. If 3 or more of these triggers align, that jumps to 60%. What are these triggers, you say? I'm glad you asked. Here they are. Credit card defaults, credit card defaults. I feel like I need a disclaimer here. If I'm slurring my words, it's because I've been up since 4, because I saw what was happening in the markets and putting the show together. But thank you for being patient, okay? But here are our triggers. It's important you know these. Credit card defaults spike to 8%. Consumer spending collapses. Now, these aren't happening. I'm just saying this is what would have to happen. 3 of these would have to be really ugly. And then the possibility of a recession spikes to 65, not 95 or 85, 65. Corporate earnings miss. Well, as you can see from earlier, there is no shot that's going to happen for the third quarter, and there would have to be a major shock for the fourth quarter, which we'll be talking about in January and February. And then mass layoffs began. All right. Housing market crashes, meaning nobody's buying, and banking crisis 2.0. That would be like 2008. The confluence of all of those happening with Jay Powell at this point, knowing he's leaving in May, worried about his legacy. No, it's not going to happen. It's just not going to happen. None of these dominoes is wobbling yet. None of them is wobbling yet. So these are the 5 triggers to watch in addition to, let's go back, in addition to these dominoes. So these are all things I'm monitoring. Do we escalate the China trade war? There's about a 40% chance of that. Middle East oil shock, 30%. And why don't we care? Because if it were 3 years ago, we would be at like 60% we'd care. We are producing more oil now than at any time in this country's history, and natural gas. All right. And soon they're going to be turning on and this is beyond the scope of this program, but when I have more data, I'll get to it in the last module. I'll talk about it. Never mind. Stay with me. All right. If the AI bubble bursts, if all of a sudden, see, this is what makes the AI thing different, guys. If you go back to 2008, 2009, there were 4X, meaning 40 times earnings, PE ratios 40 times, and they had nothing but a website. These are companies that are actually selling and making stuff and selling it like crazy, like NVIDIA, all right? Like Berkshire, like Microsoft, like Meta. New products coming out now. You can't even get the new Meta glasses. You can't get them. I tried to get an appointment. They said the nearest appointment is next month in Burbank, California. I have to sit down and get fitted for these glasses. We can't even possibly keep up with the demand, they said. That's great. Not for me as a consumer, but it's good for me as a stockholder in Meta, all right? And if the Fed just blows it, I don't think they're going to cut too late. Powell has already made so many mistakes. And again, his legacy's on the line. He doesn't want to go out of office with his tail between his legs. He might have to do it anyway, but he certainly doesn't want to do it by choice, making a dumb decision. So any 3 of these hit and a recession is pretty much guaranteed. I will not be reviewing this slide in June. We'll be coming back to this on a pretty regular basis. So this is the path, April 2026. If the S&P is down 20%, you can count on it. This month, next month, I should say, Fed cuts 25 and the market rallies, but it doesn't sustain, all right? Because if you're going to cut 25 basis points, you want it to sustain. If the quarter 4 earnings miss, now I just mentioned that, we're in quarter 3 earnings at the very tail end of that. So in January, we start quarter 4. It seems kind of strange. We're in 2026. We're talking about quarter 4, 25, but you can't really predict what the earnings are going to be for 26. So you always are looking backwards. But if these flop, that's not good. Unemployment rate rises to 5. That's that 5 handle I mentioned. We got a 4.3 unemployment rate right now. If it raises to 5, credit spreads below the banks tighten again. Don't want that. And if GDP becomes negative, and as you know, the definition of a recession is 2 consecutive quarters of negative GDP. And if that happens, that becomes a recession. So the most likely case, slowdown, not a recession. Fed cuts just in time. There he is, Jay Powell, just in time. Not too late, just in time, Powell. All right, the base case, 3/4 of it, muddles through with 1 to 2% growth. I think that's likely, but it's going to be more like 3%. And a full recession if a bunch of these shocks come through. And it's not like we're just going to wake up, guys, and they're going to happen all at once. We'll be monitoring them. But we have a really more sophisticated system now to monitor this and then act on it with your investments than we've ever had, because of 5 different AI engines that are always working. Even when I'm sleeping, they're working and giving me reports in the morning. So I can generate these charts and show them to you. So here we go. Here are the 4 paths. And now this is for the recession, not the inflation. I showed the same thing for inflation, but this is for recession. So Goldilocks, best case here, GDP 5.5 to 3. Inflation 2%, unemployment 3.8. That's a little high, but not bad. S&P 7,200 plus. We've already hit over 7,000 this year. We're not there now. Fed cuts to 3. That would be awesome. I'm on record. Come on, Jay, shock us. Bring it to 3, dude. That means that the 10-year mortgage rate is going to be down under 5. And all of a sudden, people are buying houses and selling homes because they can, find buyers. That's a good economy. 40% shot of that, folks, not quite 50%. All right, muddle through. You can see I won't read each component there, but it's just not quite as good. But it's, we get through about 75% chance. All right, so that's why I'm saying 25% here. You got a 75% chance of Goldilocks and muddle through, and then you got a growth scare if GDP gets stagnant. So we don't want stagflation, which means there's inflation and no GDP. Haven't had that for decades, all right? In my lifetime, but not for decades, okay? Inflation falls to 1.5, but unemployment rises. That is stagflation. And then a full-on recession, 10% shot of that. So either of these bottom 2 is not what we want. Either the top 2 will accept, but we got almost a 50% chance of that Goldilocks, and that is a good thing. I want to finish with AI. I know that there's continuing anxiety, I guess. I've just had to accept that AI is going to do what it's going to do, and we're going to have to adapt. It doesn't care about us. It doesn't sleep. It continues to grow, and we have to find a way to harness it to our benefit. So here's the reality, guys. According to the sources that we check here, there are 300 million jobs at risk. Not just in the US, that'd be the whole population, almost, except for the 1-year-olds. 300 million at risk by 2030. That's 4.5 years. It's not 2040, but I said 2030. All right, that's going to change the world, creating about 100 million, so a third of that, meaning that 2/3 of those jobs are going to be lost, and they're going to have to find employment elsewhere. Now, the thing with unemployment is that, let's look at this number again, 200 million. So a huge labor shift, the biggest labor shift since the Industrial Revolution 100 years ago. So what happened in the Industrial Revolution? Well, people retrained and went on and did other things. We didn't stop growing, right? But people are going to have to retrain and find something else to do. It happens. That's why they call it disruptive technology. It disrupts the fabric of society, not because it's trying to just be obnoxious as if it has a brain and a conscious technology. It doesn't. It's just the nature of it because it's so radically new. So I mentioned earlier about the nuclear power, right? That we have producing more natural gas, producing more crude oil than we have in the history of the country. And it's a good thing because in 2023, the AI use for these data centers was 460 terawatt hours. So now I'm going to look over here on my cheat sheet. A terawatt hour is equivalent to 1,000,000 megawatts or 1,000,000,000 kilowatts. So in a perspective, the average US household uses 10,000 kilowatts a year. All right, so 1 terawatt hour, will power 100,000 households for a year. So look at the screen, 460 terawatt hours. And that's 2 years ago, almost 3. 2025 used 850. 2027 projected Read the number. 1.250, which is, I mean, so I don't know what the number is after. Where's Dr. J? What's the number after tera? Meg tera or quad tera? All right. But what it means is right now, today at 850 terawatt hours, we're consuming more in our data centers than the entire country of Argentina, the second biggest country in South America. Just staggering. The data centers are using 2.5% of all global electricity. It is projected to be 10% in 10 years. And that's why they are scrambling just as hard as they can to build these data centers and powering them with some of these nuclear facilities are going to be called back into service because it's the only way you can get it done. Even fossil fuels can't keep up with it, and definitely not windmills. There will be no data centers being powered by windmills, okay? Not going to happen, or solar panels. So what does this mean? ChatGPT and Claude, I use two. These are two of the 5 I use. They are now at a PhD level reasoning across all domains, which means all search fields, with an IQ equivalent of 155. That is not Einstein, but it's way up there. It's definitely higher than mine. And that's today. And they work 24/7, 365. You're going to see that be 165 at least by this time next year. Full movie generation. A 2-hour movie can be created from prompts in 10 minutes. Picking on Dr. J again, maybe you could put a link if you can find it, Doc, in the chat here. But Dr. J has a friend in the music business who is synthetically creating music tracks now, vocals, everything. And you're just going to see this happen. And it's happening in Hollywood, as far as doing short films to present a concept for a longer movie, it'll be all digital. So the demo business of, creating feature films is just going to be gone. And scientific discovery, 3 major drug discoveries, 2 new materials. These aren't new elements, so it's not new elements on the element table, but new materials. 10 years of research in 6 months. Folks, can you see where this is going? 10 years of research in 3 months, 10 years of research in a week within several years. We don't know. We have no idea really how fast this can grow. It's going to change the fabric of society, and no one can tell you they know exactly what it is. It's something we have to follow very, very carefully. But here is the point I'm trying to make. This is not 2008, 2009, where you had companies that were just appearing on the internet. Oh, we're web sensitive now. Of course, that's more like 1999, 2000. But more like 1999, 2000 is where I should be focusing, because that's when there was a crash because there was nothing there. It was just vapor. But these companies have earnings. They're a $1 trillion company because people are seeing that there's value in them and they're buying them. I mean, it's insane, but it's the reality. So as I just said above, GPT-5, Claude 4, PhD reasoning level, full movies generated in 10 minutes. 70% of new code is AI generated. There are no coders sitting around in booths anymore. So the coders are out of business. You go to school, get a computer programming degree, and bye-bye. You got to be doing something else now. And the scientific breakthrough, it's astounding. It really is astounding. Just real quick here, I want to mention there's one area that I have an interest in pathology in the medical field. The smartest men in the field, and one of our listeners, Keith, and I know this, Ming Zhao, has said, I'll be around for a while, but there's no way that I can compete with AI as far as being able to check, cross-reference 10 million different pathology results versus my own eye. And these machines can do this in 10 minutes. It's just staggering. So the amount of money spent in this area, 86 billion 2 years ago, 189 billion last year, 312 billion this year. Yeah, you can do the math on that. That means we're going to be at $1 trillion in 2027. $1 trillion. Could it be 10% of GDP by the end of this? I'm just winging this. I didn't prepare. 10% of GDP by the end of this decade? You bet. Absolutely. because success breeds success. If people are saying, you know, I don't need this much staff, or I can get better results, or I can get research done more quickly, and Eli Lilly can beat Johnson & Johnson, because if we have the engine to do the research and get to the market faster, they're going to be investing more, which means we need more data centers, which means we need more power, et cetera, et cetera, et cetera. All right. So here's the regulation. This is the challenge. So Silicon Valley says, hey, innovation requires freedom. China will dominate if we slow down. And by the way, I think I might have missed it on a previous slide, but China says we're going to overtake the US in 2027 and be the dominant AI entity on the planet. In your dreams, China, in your dreams. All right. Doesn't mean we should stop innovating. Market forces ensure safety. Regulation kills progress, and there's absolutely some truth to that, and we can self-regulate. I don't know if I'd go that far, especially when it has to do with moral issues, moral decisions, like these emulation programs where you can make it look like a real person exists and they do something they never did in real life, and it's so close to real life that, it's bad. So Washington says existential risk requires oversight. Deep fakes threaten democracy. How are we going to know in 2028? Imagine what that presidential election is going to be like. Donald Trump will not be running for the first time in 12 years. How much fraud and just misuse of AI technology will there be in 2028? Because there's so much at stake for the presidential office, right? Job displacement needs management. Data privacy is paramount. People are terrified that they always thought the internet was snooping on them. Now they think AI is, if they just put a request in ChatGPT, what should I feed my baby? And, if it's the wrong answer, somebody's going to, DCF's going to come after them or something. It's crazy. Big tech can't be trusted. Well, I don't know that I believe that, but I do realize that it is a complicated story. So tech is arguing for freedom, government demanding oversight, and how they're handling it overseas. The European Union is in effect. In the US, it's stalled. The regulation is stalled. In China, targeting supremacy. Good luck, guys. Well, that's the show, folks. We covered a lot. I hope it was beneficial to you. If you are new, be sure to subscribe and hit the little bell so you get updated when we go live. All right, Facebook and Twitter, which is X now, LinkedIn, I send to every day, sometimes multiple times a day because there's so much going on. Next show is Thursday, December 11th. That's the Christmas show. You won't want to miss it every year. It's a special show as we wrap up what has happened in the year. If you're following my podcast, you can still get them on Amazon, on Apple, on Spotify, or wherever you listen to your favorite podcast. All right. Sayings here. I'm killing a little time to give you guys a chance to type anything in the chat. We're about 20 seconds behind on the thread. So if you've got something to ask, I'm here. Ask it now. Risk management is the key to long-term survival. And why did John Paulson say that? Because he earned $5.6 billion in the 2009 crash when people were buying liar loans and packaging credit default swaps. And he said, you're not employing good risk management. I'm going to do that and take the other side of the trade. And he did quite well. Investing is a business where you can look very silly for a long period of time before you are proven right. Bill Ackman, hedge fund manager, worth almost $10 billion by now. He probably is. So always like to end the program with this from 2 Timothy 1:7. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. And that is so true. Guys, I still believe this is the best time to be alive on this planet. I realize there are a lot of dangerous things happening out there. I live in Chicago. You see what's happening here in Chicago. If you live in a big metropolitan area, you know that it's very politically torn right now and not a really great place to be America-wise if you're a patriot. I don't have the answer for that. What I know is that my job is to do the very best for you and your portfolios and deliver you the highest risk-adjusted returns I possibly can do. We do that every single day of the year. I take a little bit of time on Saturday and a little bit more on Sunday, but I'm always thinking about the markets, folks, and doing my best for you. Thanks for listening. Come back in December. Keep listening to the podcast and follow my tweets. God bless you guys. Happy Thanksgiving. See you next time.